Metamaterials is one of the highest growth stock in the market this far in 2022, and if you own a piece of this company or are considering about buying some shares, then this video is definitely for you. In this video, we're going to talk about Metamaterials, trading under the ticker symbol MMAT. At the moment, the financial market is very volatile, and we should be careful about which stocks to pick and the exposure and the timing of our positions. This video is going to cover the recent price actions and the technicals of the stock. Before the video begins, a quick heads up that my analysis is usually based on sessions already completed and that it may not take into consideration of the latest events. If that is the case, I'm going to make follow-up videos to reflect those events if they're significant. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $1.80, closing the trading day at $1.61. We should pay attention to the $1.60 level that's very close to it because it was tested as a support and a resistance over the past month, and it is a key level to watch out to determine if Metamaterial MMAT is still in the green. Over the past 30 days, the trend of the stock has been bullish and ranging, which can be a sign that the bulls are reconsidering if and when they should re-enter the stock. The short-term outlook has been very bullish with the company, and it is having a good sequence given the challenging environment we're in. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish since the scale of the previous losses is much more significant than the recent gains. And in a way, that may give us even more hope for the future, because the downside is now much more limited than where things were previously. When we look at the price trend overall, it's been trending and consolidating, which can be a sign that there will be pullbacks, and that can give other shareholders, and us, quite frankly, an opportunity to increase our positions. The trading volume of Metamaterials is currently 6 million shares, compared to the average of 5.4 million shares. Over the previous 52-week period, its price fluctuated between $1.38 and $21.76. Now, the market cap of Metamaterials is currently at $495 million versus an enterprise value of $530 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus all the debts. If the company has a lot of debts or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, this remains an estimation of the market every time it publishes its financial statements, so it's less reactive than a market cap and often more lenient for many companies as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they may own is called goodwill. Goodwill is basically an expectation that the market has for this company, assuming that it can generate more profit or grow faster than its rivals, because it may have a better management team, a stronger brand recognition, or a bigger online following. It is basically what makes a company unique compared to the alternatives. And in other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and the enterprise value is also less reactive, to be honest, than the market cap. If the company goes to liquidation, there won't be any goodwill left, and we would have to share with the bondholders whatever the amount is that is left within the company, which I guarantee is going to be much smaller than the current balance sheet. When we compare the current price to the historical price fluctuation, the stock is 15% higher than its 1-month low, 17% higher than the 3-month low, and 17% higher than the 52-week low. On the options market, which gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 159%, versus a historical volatility of 130%. The put-call volume ratio is currently 0.02. It is normal for many stocks to tend to have a higher put option volume than what they truly deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 9,000 contracts a day versus the 30-day average of 4,000. In terms of open interest, the most recent volume of open interest is 106,000 contracts versus the 30-day average of 102,000 contracts. In terms of its shareholder structure, institutional shareholders hold about 30% of the outstanding shares. The biggest shareholders include State Street, Vanguard, and BlackRock. It's relevant to understand the shareholder composition of a company you want to buy in because it helps you to determine if you should be holding the stock long-term or to simply view it as a trade opportunity. If the stock is mainly held by retail traders, this can sometimes be a sign that the stock lacks the depth to justify long-term trust. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, this is subject to a lot of exceptions, since many great titles are also held by a lot of retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 16% of the total floats and 63% of the transactions coming out of the dark pools. Overall, my opinion on Metamaterials or MMAT is still bullish because the stock is located at a very interesting price level for the short and medium price point. And it's also very interesting that those looking to hold it long term and those who want to trade the swings. So it's very close to a region where a lot of big potentials exist. Of course, keep in mind that this is a high risk, high reward stock. So definitely structure your position with this element taken into consideration. The maximum exposure I would recommend is between 3 to 5% of your portfolio. And for the immediate term, my recommendation is to buy the stock considering the recent price actions and the promising price levels that are close to where it is right now. I would recommend to separate your allocation in batches of 20% at a time so that you can have enough room for later purchases as well. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world, and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.